It was a fantastic day in the stock market today as all four of our major U.S. equity indices closed higher by over 1%. In fact, the NASDAQ was nearly 2% by the time it was all said and done. Not only that, but it was a broad-based advance. All 11 sectors closed higher here today. All 11 sectors have strongly bullish postures, according to the market forecast technical indicator as well. And we saw about 88% of the components within the S&P 500 close in the green here today. So today was definitely a win for the bulls, which is a good response from yesterday's sell-off. So I wanted to take advantage of that move, looking at some of the other areas within the market. Consumer discretionary really perked up here recently, and I wanted to target our trade application example of tonight's video within the consumer retailing space. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's March 24th, 2022. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below. Make sure you're signed up for our email distribution list. You can find the link in our description area there. And at the bottom of the emails we send you, when we notify you of these videos release, you'll find the overbought and oversold cluster signals within the S&P 500. We're also heavy users of Twitter. My handle is @BrandonVanZ. I'd encourage you to follow me if you're not doing so already. And then last but not least, we do have a presence on Facebook. Feel free to join our group at the web address listed in the logo in front of you. All right, with that, let's go ahead and jump into today's trade activity. And as you can see, my oh my, what another beautiful day we had in the stock market here today. It seems like just a couple of days before St. Patrick's Day, we had quite a green day. I was kind of joking that the heat map looked like the Chicago River being dyed green at that time, and I could probably make the same case for it here today. This was an overwhelmingly green day. We've had quite a few of those here in just the last week and a half or 2 weeks, so quite a dramatic reversal of sentiment on Wall Street compared to where things had been kind of at the height of when the Ukraine-Russia war was kind of dominating the headlines. It still is to a degree, obviously a long ways to go before we resolve that issue, but it seems like the market to a degree has started to come to terms with that a little bit, and also coming to terms with, getting past our first 25 basis point rate hike out of Jerome Powell. So good to see that the markets are kind of hanging in there and stabilizing compared to what we had witnessed earlier in the winter. One of these little blocks or squares here that should stand out to you is NVIDIA. My oh my, look at how green NVIDIA is here today. That brighter the green, remember, the higher that stock went up. And the bigger the blocks, the larger those companies are, and therefore more influential on the S&P 500. NVIDIA was up about 9.8% today, so round up to 10%. And it did lead the S&P 500. I'm happy to report that is one of the 25 active holdings of our top-down trend trading class. So we were cheerleading that one on today for one of my classes there. And then in another class, we have sold puts right now on Intel. And it wasn't really outdone by all that much. It was up 7% on its own. And these days, of course, NVIDIA dwarfs Intel, which a lot of people may be surprised by, but that's how the market caps have shaken out here recently. But both of those kind of teaming up together on a news story here today and benefited our sold put trade in my Monday afternoon class. So we were happy to see the good news out of the semiconductor world there as well. We also have a sold put on Texas Instruments, and so happy to see that semiconductors in general doing pretty well. And I almost forgot, we also own Avgo, as a matter of fact, in our dividend growth investing class. So we have apparently a lot of exposure to semiconductors in my various premium classes, so I'm happy to see them kind of starting to stabilize here at the moment. You'll also notice that the vast majority of other major blocks that you see in front of you were green here today. Microsoft was up once again, up 1.5%. Apple was up 2.2%. Apple has just been crushing it lately. It's kind of gone a little bit under the radar, but it's been going up nearly every day for a couple of weeks. And there's rumors kind of floating around that they're going to start maybe a subscription that would be kind of all-encompassing where you could have, a new iPhone every year, along with a lot of the services that they provide you, all for one convenient rate. So that idea has been floated before over the years, but perhaps the market's keying into it a little bit more at this moment in time. Down below, you will see that Alphabet and Facebook also were up today, helping that communication services area. And then Tesla, remember Tesla was the leading stock in the S&P 500 when I did this video with you guys on Tuesday. It was up about 1.5% here today as well, continuing its good fortunes here lately. Now remember on Tuesday I had mentioned that there was one area that was a bit of an underperformer, and that was energy. Today energy actually held in there a little bit better, and that's somewhat noteworthy because oil prices themselves were down today, yet oil stocks really didn't suffer as a result of that. So that was kind of interesting there. Exxon actually finished slightly higher, as did Chevron there. There were a handful of energy stocks that did finish lower, but on the whole, all of these sectors closed in the green here today. So it was a broad-based advance. To take that concept a little bit further, let me go ahead and show you here how we kind of track market breadth on the Thinkorswim platform. If you come up here to the Market Watch tab and then go to Visualize and then pull up the S&P 500 public watch list, you can see that today 438 stocks of the S&P 500 closed higher here today. So that's about an 88% hit rate. So again, overwhelming win day for the bulls there. So giving you the sense that the bulls want to retain and hold the strength that they've been kind of garnering up here over the last week or so. Remember, everybody's kind of waiting to see if the bulls will fall flat on their face again, like they've done a couple of times here so far in 2022. But so far, they're holding the line, and I think that's a positive response from the marketplace, and maybe we can build off of this moving forward after having such a difficult start to 2022. Let's go ahead and also take a look at our charts now. I like to show you guys this one whenever we have an up or down move of over 1%, and today was another one of those days. We kind of talked about that on Tuesday, where I was saying 5 out of the previous 6 trading sessions, we were up at least 1%. Well, here we are a couple days later, and once again, we're up over 1%. Now, that does need to be taken into perspective. We did have a down day of over 1% yesterday, so you could kind of get away with saying, we're just making up for the losses that we had yesterday. But if you look up at the candles up at the top, you will see that we closed today higher than yesterday's high. So in other words, not only did we just make up for yesterday's losses, but we did add to that as well. So I think that's important to take away from that perspective. Now, in terms of the S&P 500, we're kind of at our highest levels here since basically going back to about February 10th, somewhere in that general vicinity. Naturally, when the stock market is up, all else being equal, you should assume that the VIX falls, and that was the case here today. You can see in this label over here that the VIX fell to 22 or thereabouts at this moment in time, and that's a far cry from the 30-plus VIX that we had been getting used to about 2 or 3 weeks ago. And again, I'll stress that had you been doing sold put trades or other, option selling techniques, this is benefiting you. This big slide in the VIX is really helping you along. It's really helping you along if you did bullish trades like those sold puts. So a number of you probably have been doing those types of trades, as we've been doing quite a bit of them in my classes. And so we are happy to see the market kind of stabilize here, as opposed to continuing to move lower and lower and lower, and it just kind of felt like we were falling into the abyss. Now all of a sudden it feels like we have stabilized a bit more. So I think a strong sign there, all else being equal. Now we still got work to do. Keep in mind these labels up at the top here. You can see that over the last 3 months, we're still down about 4%. And year to date, we're still down about 5%. So it's not necessarily the rosiest of environments, but it sure could be a lot worse. And we're thankful for what we do have in front of us as more bullish investors, at least those of us that are longer term oriented. I do realize that some of you may have some bearish shorter term trades on, and that makes sense, depending upon the market environment. In fact, on that note, I should mention here as well, some of you already caught the Telegram trade alert that I sent out at the end of the day here today. But I did shut down that Graco short selling trade at the end of the trading day today. I was feeling very good about that one because obviously I just put the trade on 2 days ago, and as you can see, it's done nothing but go down, and it came within 2 pennies of touching our price target here in the late afternoon, and at the end of the day when it looked like it wasn't going to quite get there, I just decided to shut it down. I'd rather have that when we're only like 10 or 15 cents away from our max gain, shut it down, as opposed to leave it on and then, you know, watch the market gap up tomorrow, or this stock have a good news story that comes out of the blue and just completely derails your trade. So anyway, just a heads up on that for those of you that might not have caught that on our Telegram app if you're a premium member of Market Scholars. Not only did I lock in gains on our short selling trade there on Graco, but earlier this morning you probably saw this telegram as well, that on my long trade on Corteva that I put in on this video maybe a week and a half or 2 weeks ago. Remember, that was a bullish swing trade, so the opposite of Graco, and that one did hit our price target today, and we did lock in max gain on that particular trade as well. So today was a good day for some of those market outlook related trades that we've been putting on. Anyway, let's go ahead and take a look here now at our 4 grid, and this is chart 4B for those of you that are following along at home. And remember, when I was with you on Tuesday, I was mentioning how all 4 of our charts were now strongly bullish according to the market forecast technical indicator. It's pretty easy to spot here on this 4 grid because you'll notice that the background colors will assist us with that effort. If they're dark green, as all 4 of them are right now, then that means we have strongly bullish postures. Now at that time, remember I was mentioning that the Russell 2000 was the only one in the upper reversal zone as far as its green intermediate line. It's up there above 80. Remember, you can always read that directly in the labels of the charts themselves. The other ones weren't quite there, and they're still not quite there, but there has been continued progress in that effort over the last 2 days. In fact, you are knocking on the door of that upper reversal zone on S&P 500 here. It closed today at the 77th percentile. So if we have another update tomorrow, pretty decent chance that the S&P 500 actually joins the Russell 2000 in that upper reversal zone. But as long as all of these green lines are traveling higher between 20 and 80, then we would still consider them bullish. And if they're traveling higher between 50 and 80, they'd be considered strongly bullish, which is that green background color of the chart. And then once you get into the upper reversal zone, then it doesn't really matter if you're traveling up or down. As long as you're simply above 80, we would consider that to be strongly bullish as well. So we give it a little bit of leeway up there in those higher echelons. So it's a good sign, in other words. Now, obviously, these charts still have a little bit of a downward bend to them, and we can tell that because all of our charts have price above their moving averages, but notice that none of the moving averages are green at this moment in time. They're all yellow. And so what that is telling us is that today, all of the moving averages are moving lower. Now, these are 30-day moving averages, to be precise. And, a couple of days ago, we actually had the Russell 2000 above its rising moving average. So it is kind of interesting that we went back to a falling moving average here today. Remember, the moving average itself is a lagging indicator. So this green part right here was probably a direct result of these positive candles back here. And then after that move, we had a move lower, which is now redirecting the moving average to a degree right now, because remember, there's always this process of lopping off the 30th day back and then adding the most recent one. And so that does have the ability to kind of change the direction, especially when we've been more choppy, right? A lot of times you don't notice that because we are directional in nature. We're either going straight up or straight down. But with the Russell 2000, this has largely been a sideways chart for the last 2 months at this point, right? If I were to kind of highlight this area that I'm circling with my mouse, that was on January 19th. So just over 2 months ago, and we were basically trading at the exact same level that we are right now. So for the Russell 2000, it's been a little bit more sideways. For some of these others, there's been a little bit more direction to the downside, and hopefully that is being kind of reversed right now, and we're in the midst of that reversal, but we'll see. Right now, I think it is an optimistic sign that we've spent I don't know, 5 or 6 trading days, depending upon the index, above the moving average. Remember, that was one of the things I really wanted to look for when we were having those chats with you previously. And I said, you know what, I'm not, right now my mindset is that we probably won't be able to have a reverse trend. But if we do, the Russell 2000 is the one that I expect to lead because of X, Y, and Z. And I gave you those reasons. So it's not as though I wasn't thinking that there was a possibility. There's always a possibility of a trend reversal. But what I care about is how much time do we spend above the moving average? Because my worry from before was back here on the Russell 2000 at the first part of March, end of February time period, we spent about 4 days or so above or on the moving average, but we didn't really get any separation whatsoever. So it was a failed breakout attempt. This one feels a little bit more substantial, a little bit more robust. Notice how we're not touching the moving average itself. There is a little air pocket below the candles of the last 4 or 5 days, and we're trading a reasonable amount above that area and holding it for a longer period of time than we had back here. So I think that's what kind of defines the difference, and I think that means that this rally attempt is going to be viewed as more legitimate than what we ultimately discovered with this one back here. Now, obviously, there's a lot of things going on in the news, geopolitical concerns and the Fed and inflation and everything else, right? We're about ready, by the way, to start earnings season again. Isn't that crazy? We've had all these other things to sink our teeth into, and we forget that we're almost at the end of the quarter. And starting the first or second week of April, we'll start to see the bank earnings rolling in once again, and we'll start that process all over and see how corporate America is handling some of these supply chain dynamics and some of the inflationary pressures and things like that. So it's going to be fun to see how things shake out. But right now we're kind of starting on a more stable footing, I would say, and I think that bodes well for us. So to put a ribbon on it, so to speak, again, all 4 of our charts here are trading above their falling 30-day moving averages. All 4 of our charts have strongly bullish intermediate postures according to the market forecast technical indicator. S&P 500 was up 1.43% today. Dow Jones was our laggard today, up 1.02%. The NASDAQ Composite was our leader today. It nearly closed up 2%. In fact, the NASDAQ 100 did, but the NASDAQ Composite that we track here was up just under 2%, 1.93% to be precise. And then the Russell 2000 was up 1.13%. So strong day across the board. Not only did we have the breadth that we would normally like to seek out with 88% of the companies higher, but we also saw all 4 of our major indices that cover everything from small caps to mega caps. All of them were up a minimum of 1%. So that's a pretty rare day there, and I think it is a bullish sign, all else being equal. Let's go ahead and step away here and go to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. We had a good conversation at the end of my question and answer session today about my philosophy about this market outlook video and my impression of how many of you view the video and whether it's important to you or not. And a lot of you do a wonderful job helping support that, and I really do appreciate that. So last time I did the video here on Tuesday, you guys did a fantastic job there for me. 114 of you took the 5 seconds out of your day to click like for me. So thank you for doing that. Remember, as long as we're up and over 100 likes, I'm happy to do a full-length video for you the next time around, which is why we're doing this right now, which will include a full trade application example and all that jazz as well. So thank you to all 114 of you, but in particular, Vodak Khan, if I said that correctly, Roger, Next Era Trading, Greg. I always joke with Greg that he's my Dutch brother. Anybody that has that Van or Vandy in the last name, that's usually referencing somebody that has Dutch heritage. Irene Zing, thank you, by the way, Irene, for your lovely comments there on Twitter as well about your experience with Market Scholars. Lucius and Eve and Claire and Paul and Valerie and Fred and Big Jock and Victoria and Gerald and Kirk and Pam and Margie and Doug and Tim, Ray, Surendhar, Serene, Doug, Keith, Carl, Joe, William, Tom, and the list goes on and on. I can't do y'all because obviously we only have a limited amount of time here. But I do see your names coming through anytime I check the notifications and all that, and I appreciate each and every one of you for taking that extra effort there to help promote our fledgling business here at Market Scholars. I know David feels the same way, so thank you to everybody who helps us there. Also, while we're over here on the internet, today I taught my question and answer session. So for those of you that are premium members of Market Scholars, some of the things that we discussed here today were kind of reviewing some dividend growth investing concepts, including the Graham number. So we had a long conversation about Benjamin Graham and my personal journey throughout the stock market ever since I started trading about 22 or 23 years ago, as I used to be what some would refer to as a Grahamite. No longer am, but at least could share some of my background history with folks when I answered that question. Also shared my thoughts around the Chowder rule, which I think is an interesting way to look at dividend stocks when you're comparing current yields along with dividend growth rates to combine those to find outstanding choices. Obviously, they need to be used supplementally with everything else that you're already doing and not on a standalone basis, but also a very good way to look for opportunities. And then the Tweed factor as well, which kind of takes that same concept, but then blends a PE ratio in there. And so we had a good time kind of looking at a couple of companies that might be good fits for those particular rules there. We also got a question about looking at Best Buy's business model as a dividend growth investing candidate from Claire. And I want you all to put a pin in that because this will come back around at the end of tonight's video. But we did kind of do a breakdown on Best Buy's business metrics and kind of some of the ways that they've been able to just defy the haters over the years. Everybody that called them Amazon showroom. Somebody in class was saying, well, maybe it's the opposite now. Maybe it's Amazon is Best Buy showroom. Who knows? But they've done a tremendous job over the years as well. We had a question about Whirlpool, either buy it flat out or sell a put, and some of the considerations that go into that kind of a decision. Sharing my own personal philosophy around not only that decision, but my thoughts on that company there as well. And then got a question about how do I handle longer term positions on the market outlook videos and how I have to kind of think about things like buying power effect and how it doesn't really jive with a long-term philosophy as much as I can show you guys in my Tuesday morning dividend growth investing classes. Also, while we're over here, let's take a quick peek at the factor selector. A reminder that this actually gets put together on Tuesdays, so after Tuesday's close. So it's a little bit stale right now by a couple of days, but not the end of the world in this case. Remember, we review this typically Wednesday morning in my factor-based swing trading class for premium Market Scholars. But dividend yield did hold the number one spot. Like I was mentioning to the crew yesterday morning, I wouldn't be surprised to see that change here at some point in the coming weeks. It feels to me like it's gotten a little bit long in the tooth, and now that the markets are willing to take a bit more risk again all of a sudden, it kind of feels like the sentiment may be shifting just a little bit around that philosophy. So I'll be curious to see how long they can retain that number one position, because there's a new candidate in town, and that new candidate is momentum, like a shot. It went all the way up to the number two position. And when you have a historic day, or a historic week, I should say, like we saw last week, where markets were up basically 1% 4 straight days in a row, that can have a dramatic impact on those momentum types of growth stocks. So I think that really benefited them there. Low volatility fell tremendously. Remember, there's a lot of interest rate sensitivity to those low volatility stocks. And so just be aware that those utilities and REITs have struggled on a relative basis as we've seen interest rates continue to go up pretty dramatically. And then quality kind of clicked back into the number 6 spot. I don't think there's anything tremendously bad about that particular factor. It's just that a lot of the other factors are doing better at this moment in time. So let's go ahead and get back on over here and do some 12 grid analysis now. Starting with chart 5A, and this is our asset class 12 grid. Okay, now as this pulls up, a reminder that the background colors will tell us whether we have a bullish or bearish intermediate posture using the market forecast technical indicator. If you do see a dark green background, that means a strongly bullish intermediate posture. If you see a light green background, it's a weakly bullish posture. Same thing with the pink shadings as well, although right now in front of us we just have the darker variety. Speaking of which, let's talk about those two first. The bond market continues to struggle. Story of the year, perhaps. TLT, BNDX, so whether you're looking at U.S. government bonds or foreign bonds, they continue to slip away. And remember, that is as a result of the opposite effect of what's happening with interest rates. When interest rates go up, bonds go down, and that is the environment we find ourselves in right now. TNX was up yet again today and closed at 2.34%. Which is neck and neck with its highest close in the last couple of years. So it's actually a little bit higher there on Tuesday when I did the video, but we're not that far away from it. So we're still up there, kind of hanging out at that same level. So very strong performance out of interest rates here, not only after Jerome Powell increased interest rates, but even well before that in anticipation, and then continued after that. So it's been robust and strong, and it's kind of felt like a one-directional type of a trade right there. At some point, you'd figure they got to take a little bit of a break. Whether we're getting closer to that or not, anybody's guess. We did have an oversold cluster signal on TLT on Tuesday, as I mentioned to you guys at that time. So it is possible we could have a little bit of a reflex rally to kind of bide some time here. But right now, clearly the trends are in place. Trends for bonds are down. Trends for interest rates are up. Over here on the left, on the bottom rung, we can talk about the commodities now. Remember that I talked about oil and gold on Tuesday and how oil was still bullish, but gold had a pink background color. But I said, you know, if it were me and it was a gun to my head, I would rather go long gold than to go short gold, because I wanted to believe in it right there on that candle 2 days ago, as I was mentioning to you at the time, sitting right on top of its 30-day moving average, which oftentimes can be used as a support launch area. And any of you that would have gone bullish on gold in the last couple of days probably have a nice smile on your face. It's actually looking like a pretty healthy bounce there. Who knows how long it holds, but I like the looks of it right out of the gate. And so hopefully there's a little bit of potential there. It's interesting because today gold was up, oil was down. A lot of times they kind of travel in unison, but we've been seeing them kind of separate from one another here over the last couple of weeks, where oil prices had been doing a lot better while gold was stagnating and going sideways. And now all of a sudden it kind of looks like oil wants to maybe roll over here. We'll have to watch this in coming sessions. At the same time, where gold looks really healthy on this bounce higher. So maybe oil just got a little bit ahead of itself there. Who knows? But right now, what I can tell you is that they both trade above rising 30-day moving averages. And unlike Tuesday, gold has now flipped back to a weekly bullish posture. You'll notice over here, US dollar kind of held in line, held in check here today. Didn't really move a whole lot, but is still hanging out at the higher levels that we've seen over the last 3 weeks or thereabouts. Bitcoin had a really strong day. This was a nice one here. Take a look at that candle. These ones are a little goofy, by the way. Sometimes some of you might have noticed that this particular ticker symbol changes on a different schedule. So sometimes by the time I'm actually doing the video, the amount that Bitcoin was actually up was more than this, but it's already kind of rolled over on the futures contracts or whatever. So sometimes that can be a little bit confusing, but a lot of times I just look at the size of the candle, and you can see that the size of the candle on Bitcoin today was very nice. This was a big move for Bitcoin, and it puts us right back up at these resistance areas from middle of February and then also beginning of March. So keep a look at that particular area right there. Remember, you can also pull up Bitcoin with /BTC. And that's another way to kind of go about it. but it's just a slightly different view there. So however you look at it, you can see that they're both kind of up in that same general echelon. For those of you that want to trade that more within the stock market as opposed to futures contracts, there is a fund out there, GBTC is the ticker symbol, that does track Bitcoin. It does so maybe not quite as efficiently as some people would like, and there are fees involved with it and things like that, so it's not as pure of an experience. But nonetheless, if you're just planning on trading Bitcoin quickly and not making a big deal out of buying and holding it, you might just prefer the convenience of doing it through your brokerage account. And so therefore, GBTC might be worth investigating here if you can get it up and over where it was trading here on February 9th and 10th, somewhere around that general vicinity. And we're approaching that here yet again. So kind of interesting there. Keep your eyes on Bitcoin. And then up here on our upper echelon, you can see that we have green charts across the board here. We do have the strongly bullish postures on the U.S. markets and on foreign developed stocks. We're still sitting with a weekly bullish posture on EEM. And in addition to that, just be aware that EEM is still trading below its falling 30-day moving average. Notice that EFA is already back up above it. So of those two, it seems like EFA is a little bit stronger. By the way, I did hear today that Russia reopened its stock market. I had brought up that comment briefly in the video on Tuesday saying I don't think that they have yet, but I've been on vacation, so I don't know for certain. And then I did hear today formally that they did reopen their stock market in Russia. Now remember, that's a different story for the Russian stocks that trade in the United States. There, the trading halts are dictated by, let's say, the New York Stock Exchange or the NASDAQ. So it's a different story entirely there. But at least markets are back up and running in Russia, and therefore, that is not getting all clogged up and people can flatten their trades if they had trades over there. Obviously, I have no business being over there, so I wouldn't even know how to open up a Russian account personally, but hopefully the flow of capital is a little bit better for all parties involved when that is a possibility. So we'll see how that goes, and from what I understand, the Russian market was actually up today. Now remember, it was down tremendously going into the shutdown of the exchange. But some people might have figured that once they reopened it again after being closed for a couple of weeks, that the selling would just pile on once again, and it really didn't there in that particular case. I'd be curious to see how Russian investments actually do. We've talked about the story about how Coca-Cola and Starbucks and those types of companies are pulling out of Russia. It makes you wonder, well, if American companies are pulling back, but Russians still want to spend money, maybe it's the purely Russian companies that will benefit from that. I don't know, right? If you're the only game in town, even if your product or service would have been previously considered, second rate, perhaps the consumers in Russia will rush to those Russian corporations, and those Russian corporations very well might become more profitable in the future now that they don't have the competition from other Western nations. It'll be interesting to see if that is how things shake out, but thought I would pass along that news information there for you as well. All right, let's take a look here now at our Sector 12 grid, and this will be chart 5C. Now, I shared a tweet about this a little bit earlier, and I was mentioning how not only did all of our sectors close higher today, so every single one of them was green today, but you can see that all of our sectors now have strongly bullish intermediate postures. That's what that dark green background of the charts is telling us. So that was impressive too, because remember on Tuesday that was not the case. So this is kind of a clean sweep, a clean sweep of bullishness today, and a clean sweep of expected bullishness from an intermediate perspective as well. Now, when you start breaking it down on a more granular detail, you can see that there are some differences in the charts themselves, and there are still some that look a little bit precarious to put it at best. And I would throw the consumer staples in there as just one example. Yes, the staples were up 0.7% today, but they're still resting their head just under that moving average, or at least right on it, and so it kind of gives you the impression that it wouldn't take much to push them down once again. A lot of the others are looking more healthy, and I think that's a good sign, right? If you got to sacrifice one sector for the health of others, one of the sectors you'd be willing to sacrifice is consumer staples. Doesn't really do me any good because I'm a big investor in consumer staples from a long-term perspective, but most of my holdings I've held for many years. So I take the good with the bad there. But the reason I say that is because consumer staples are generally perceived as being defensive in nature and a place where participants will go if they're nervous about the stock market. If participants are excited about the stock market, they will go somewhere else other than the boring old consumer staples. So if we've got to kind of make one the sacrificial lamb, the staples is right up there with the best of them from that perspective. We'll take the extreme bullishness that we saw out of, let's say, materials today, up over 2%. Technology was up 2.6% here today. Those were our two big winners. In terms of laggards, again, all of them closed higher today, but it was the energy stocks that closed up by the smallest amount. They were only up 0.25%. And again, that can actually be viewed as a win because oil prices were down today. So oil stocks were up on a day when oil prices were down. These things are kind of acting like Teflon here over the last 3 months. It's just up, up, and away, while the others have obviously had lots of chop and slop along the way. It's been a little bit more difficult trading in all of the 10 other sectors, but with energy, as long as you've been willing to get on board the bullish side of the train for the last 3 months, you've usually been rewarded for that decision. So let's go ahead and now get into our trade application example for the day. Wanted to point out real quick here that discretionary was up here today and obviously does have that strongly bullish background color there as well. And then I want to now bring us on over here to chart 2A. This is our dividend stair-step chart that we use in my longer term classes. And I'm going to pull up ticker symbol BBY. And this is the stock that I had mentioned earlier that I got a question about from Claire in my Q&A class earlier today. And I said, you know what? This is such an interesting situation here. I might very well just steal your idea. Now that's maybe a little harsh because she was actually asking me about the stock itself. And I said, well, I think it's actually going to be a pretty interesting sold put candidate. And I ended up having to do some other things here today with renting a carpet cleaner that I got roped into that I was sharing with my class that I didn't realize was going to be the case. So I was kind of running around a little busier than I normally would be, and so I didn't have as much time to sink into finding a trade idea. So I thought, you know what, since we already reviewed that one in class earlier today and I like the setup, why not just present it formally here in the market outlook video. So let's talk about Best Buy. You can see currently Best Buy, ticker symbol BBY, is yielding about 3.64%. Remember, that is considered a high dividend yield. The TNX, as mentioned before, is trading at around 2.34 or whatever it is. So this is a yield in excess of the S&P 500 naturally, and then also in excess of the 10-year Treasury yield. This is a stock that, according to our historical measures over the last decade or so, generally is looked at as a buy for the long-term perspective when it has a dividend yield of 3.95%. So this has been known as a little bit of a higher yielding company, mostly because it's more cyclical. We had a long conversation about that in class today. So for those of you that are premium members, I would encourage you to go back and watch the recording there as well, because obviously I can't get into all of those types of details here in this limited time frame in this presentation that we do for free on YouTube. But there are reasons behind that. But the point is, it can fall out of bed in a hurry, right? It can fall very quickly, like it did back here from 83 down here to 48 or whatever it was. You saw it fall dramatically right back here as well. You saw it torpedo during the COVID crisis right there. You saw it really fall off a cliff late last year, right? So this is a type of stock that can move to the downside in a hurry. And therefore you have kind of wider ranges in your average high yields and your average low yields. So the average low yield is the one that concerns us most, or I'm sorry, the average high yield is the one that concerns us most right here in the blue area. But just in case you're wondering, the opposite is also true. This orange line up at the top is giving us a rundown of what the average low yields are over the past decade or so. And so anyway, what we try to do in my long-term classes is buy stocks when they hit the blue zone on the dividend stair-step chart as long as we want to be investors in their business, right? Some people just don't like the business model, and that's a completely different story. And if that's the case, then obviously you're going to want to pass on this trade idea or any other one that I present that touches upon that. But you can see here in this case how when Best Buy previously has come down to that blue area, or at least in the vicinity of that blue area, you can see that it typically has resulted in a good decision to be a buyer of the stock for the long term. And we're once again approaching that area here. If it gets down here to this blue line, which is at $89.11, at that price, it would have a yield of 3.95%. So in other words, the current yield is too small because the current price is too high. So we wouldn't buy this outright right now, but if it were to fall into that blue zone, we would be interested in that possibility. Now, some of the other things that you might want to be aware of, this company is quite attractive from a dividend growth perspective. It's got about 18 years in a row of dividend increases, so it's not quite a dividend aristocrat with 25, but it does take us through not only the COVID lows, but also 08, 09. It was raising its dividends back then, and that is maybe a difficult thing for a lot of consumer discretionary companies to claim. So 18 years in a row of dividend increases, a payout ratio of only 35%. This is a company that's making robust profits right now. Their last profit was $2.73 per share. The previous quarter was $2.08. Before that, it was $2.98, and then before that was $2.23. So if you add all four of those most recent quarterly earnings announcements together, you've got a company that's been earning about $10 per share. And of course, with the stock trading close to $100 per share, working those two numbers into one another results in a PE ratio of around 10. This is a dirt cheap stock right now. Now remember, the future does not have to match identically the past, so if earnings were to fall for whatever strange reason in the coming years, perhaps this is not as good of a sale price as you might be expecting right now. But what I can tell you is that 9 times earnings in this market is considered quite cheap. You can also see this stock has done quite well over the last 10 years. It's up about 372% over that time period. You can also see that it's kind of trading in the lower half of its PE ratio range over the last 10 years. So what I opted to do here today, since I was a little bit out of time, is I knew this one would be an interesting setup or an okay trade idea. So I sold a put on this one. Remember, a lot of times I don't do that if the market is up like it was today, but again, I was a little bit out of time, so maybe not perfect on that count there, but I still think it's a valid trade idea even if the market was up today. So I sold the $80 put in the month of May, and I did that for over 80 cents. Can't remember where it was. I think it was actually 93 cents, so over 1% return on risk. So with that, I want to thank you for tuning in to tonight's video. Remember, if you got value out of this, please click like for me there on Twitter. As long as we're up and over 100 likes, I'll be happy to do a full-length video for you again on Tuesday's video. But until next time, I want to wish you all the best of success with your trades and your investments. Goodbye for now.